What is driving the persistent strength amid the worries about the economic recovery now taking a step back as a result of the hotspots around the country for coronavirus?
There's a lot of uncertainty and a lot of worry, but I think the underlying thing is the Fed. The Fed has said they will keep interest rates low. They will keep it at zero for the next 2.5 years, and they have flooded the system with liquidity. And fiscal stimulus has already been at $2 trillion. We don't know what the next package will be, but it looks like there will be one. So I think this provides tremendous support for the market and valuation support, which is a big part of why I think we've seen growth stocks continue to run. It's just not that they're the beneficiaries in this semi-shutdown, but they also can support higher valuations.
So you don't think the rotation takes place now, Barbara?
We've seen this. I think we saw this rotation start about a month ago. We've seen it a year ago. I think we've seen this over and over. And the question is it sustainable? Because, again, I see it as I did a month ago, that this is really rotation. These stocks like Amazon has been up 300, 400 points, racing toward its price target in the last few weeks. So this is a normal breather. You've got to consolidate gains. And so you go for the cheaper stocks, and that's cyclicals, industrials, because I don't think that the fundamental economic outlook has changed. We are recovering. I think that recovery will continue, but it's not going to be a straight V up. I think given the unemployment could stay high in low double digits, I think it's going to be slow and halting, but improving. So I think that it's too soon for industrials, for cyclicals, but we will have a rotation short term into those because those are cheaper compared to where we've been the last few weeks.
Let's talk banks. Earnings, of course, kicking off this morning. JP Morgan and CITI beat estimates, helped by a massive surge in trading revenues for the quarter. Wells Fargo, which doesn't have that trading exposure, the notable underperformer, reported a 66-cent loss per share. Wells Fargo also saw provisions for bad loans rise more than JP Morgan and Citi did. We asked Wells Fargo CFO John Shrewsbury about this earlier this hour.
We've gone portfolio by portfolio and done bottoms-up work throughout the course of the quarter, and I think everybody's got a better line of sight on at least the fact that there won't be a V-shaped recovery, and that in parts of the economy that have opened up over the last few months, we've had some close back down, et cetera. That's all new and incremental news, and different banks will process that differently. They'll apply it to their different types of loans, but that gets us to the level where we are, which at about $20 billion, or call it 2% of our loans overall, actually compares appropriately on a mix-adjusted basis with the others.
Overall take on banks' earnings so far? Dave Ellison, your overall take on banks' earnings so far?
Well, we've only had 3 out of, I don't know, a couple thousand, but I think the take is I think they've got their arms around what's happening in credit. Certainly they've been looking at that very hard for 6 months. And I don't think that's the issue with the companies and the valuations. I think the issue is the level of rates and the lack of loan growth. And I think that's the long-term problem that we have in the industry. And that's why the valuations are where they are, meaning they're at very, very low valuations relative to certainly tech stocks and historically relative. So I think it's the level of rates and it's the lack of loan growth. Credit, they'll work through. They've got plenty of earnings. They'll get through that. They've done it before. 2008 wasn't that long ago. The challenge is where are rates going? And if we're going to end up like Europe or Japan, that means margins are going down and the stocks will probably follow that.
Did we get a tone, Dave? Do you have a good sense of what the tone was from the bankers as far as forecasting what's next for the economy and for their industry?
Not as much as I had hoped. Clearly, they have more access to customers than we do or I do, and I think the issue is that, as I call this market the baker's dozen market. You've got 12 companies that are running the whole economy, and the Fed's carrying everybody else. And the Fed is carrying these banks, and so is the federal government in their program. So, it depends on what the Fed does, and I think we all know the Fed's going to stay in. The question is, what does the federal government do? And if they start to, in a sense, quantitatively tighten by taking away some of these programs, it's going to have an impact on the unemployment level and the delinquencies that they haven't seen yet. So the industry is preparing for a recession that hasn't happened yet if you look at the non-performers and the charge-offs, but they have a 6-month, at least maybe a 9-month head start. And that's why they're reserving so heavily, because they're concerned, I think, that if the government pulls back in terms of their stimulus plans, it's going to create a lot of losses for them. And that's the risk that we have in the next 2 or 3 months.